go over the exam in class. So I basically went back and looked at some of the stuff that was on the last exam, brought it forward, really hone in on the key concepts as the takeaways, and then some of the stuff will probably go away, except for the evaluation work and the case studies. So we'll get a little bit smaller. But we need to talk about negative interest rates, negative interest rate environment. We will probably be confronted with negative interest rates in the next recession. The Fed's already talked about it. It's already been implemented in Europe. It's already been implemented in Japan. The books, textbooks, are being rewritten right now to include chapters on negative and zero interest rate policy because they've never been here before. So we're going to quickly go over what the impacts of negative interest rates will have on the marketplaces and financial institutions because it's just too big to ignore. What is the motivation to drive interest rates negative? To devalue your currency. That's what the Europeans did. That's basically what the Japanese did. Why would they devalue their currency? Because they want to make their exports cheaper so they can export more, because they're export-oriented economies that need to grow out of their recessions. So they implemented negative interest rates to drive down their currencies, to make their exports cheaper, to export more, to grow out of the recessions. That was the short-term impact, which was fairly successful in Japan and in Europe. However, those short-term positives are now turning negative, okay? Because with negative interest rates, savers and investors who buy these Japanese and European sovereign bonds are getting negative interest rates. So imagine you're basically giving your money to the government and paying them to basically invest in their bonds. It's never happened before, okay? So savers and investors are being hurt by negative interest rates. Financial institutions are being hurt by negative interest rates because they have to buy the sovereign bonds for liquidity purposes, but they have to pay the government to basically buy their bonds, okay, at negative interest rates. And because the banks need to continue to pay depositors interest on their deposits, they are being impacted significantly by the negative interest rates on the bonds and the money they have to put out on the deposits. So their interest margins are being squeezed. They are holding more capital because their interest margins are being squeezed. If the interest margins go down, their stock prices go down, which they have gone down. And when the stock prices go down, their leverage ratios go up, and they got to hold more capital, which means they don't lend as much money out to businesses and individuals. So you're actually seeing people who deposit money at banks are not depositing money at the banks anymore. They're converting it to cash and holding cash. Because why would I put my money in an account or buy a sovereign bond where I'm basically getting zero interest and or negative interest if I'm buying the bonds? I'm better off just holding cash. So people are holding huge amounts of precautionary cash balances and not putting it into the banking industry, which is causing disintermediation. People are pulling their money from the banks, and the banks now have less money to lend out to businesses and individuals.
Won't loans have very high interest rates? If a bank gave me a loan, I would have to pay a very high interest rate on it.
Well, theoretically, the negative interest rates are trying to drive down the cost of capital and drive down the interest rates. But the bank needs to maintain a certain spread, a certain margin to cover its costs, and to also provide a profit to the shareholders. So at some point, the interest rates will start to go up to compensate for the losses that they're incurring on the bond investments and the losses they're incurring to pay the depositors. So yes, at some point, it'll probably push down the interest rates on the loans at first, but then as the deterioration, the destruction starts to take hold, then they will have to start raising interest rates and paring back on their lending, you and then you.
Well, isn't negative interest rates the idea is to get people to pull loans out or to
borrow more. To borrow more, but they're not borrowing it. They're not borrowing more because they're scared. Okay. The incentive too is with negative interest rates is to get people to consume, to borrow and consume, to invest and consume more because they're getting negative interest rates or really low interest rates on their money, which isn't happening either. People are actually holding more cash and saving more because basically negative interest rates indicate a recession. So remember the Fisher equation? You know, it's real interest rates plus inflation expectations. Well, if inflation expectations are really negative, then your nominal interest rates turn negative. So basically, people are saying, well, heck, you know, if interest rates are negative, we're probably going into a recession. What was your question? I'm
You
sorry.
just answered it.
Okay.
Thank you.
Yeah, thank you. So negative interest rates also have an impact on asset prices. Because you know that the risk premia model to calculating the cost of debt and the capital asset pricing model to calculate the cost of equity has the risk-free rate in it. And if the risk-free rate is negative, then that means that your cost of debt and your equity is being driven down by negative interest rates. And with very low costs of debt and equity, it causes bond prices and stock prices to be inflated. You're pushing down that denominator in your perpetuity and in your Gordon growth model, which is causing valuations to become extremely high. And currently, in the United States, you have a stock market bubble at zero interest rate policy. You have real estate bubbles in zero interest rate policy. And China has a real estate bubble, and there's not really any bubbles in stock or real estate in Japan because they've been in a recession for basically almost 15, almost 20 years. So there's major implications to negative interest rate policy, not only on the cost of capital, but on financial institutions and their intermediary effects. It's having an effect on capital markets, both bond and stock markets, and we still do not know what the long-term implications are because it's never been used before. So it will probably, in the next 10, 15 years, we will know what the impacts will be, but from what I can tell, it doesn't look good. Okay? It's not a policy that is recommended, but it is a policy that the monetary authorities have decided to enact.
So it would cause inflation on asset prices.
It creates asset price bubbles because it drives down the discount rates and drives up the valuations. So negative interest rate policy could create asset price bubbles. And definitely zero interest rate policy in the United States has created stock and real estate bubbles. We are currently in a commercial real estate bubble and a stock market bubble currently, and a bond market bubble. Right? Because if interest rates are really, really low, then bond prices are really high. And once you go to zero, bond prices are at their all-time high. But if you go negative, they can even drive bond prices even higher, above the limit.
So we, in the United States, haven't reached negative interest rates yet.
No, we haven't gone negative yet. We've seen it. We've seen it in during the financial crisis and other crises. People will flock to bonds, and they will bid up bond prices so high that it actually drives the yields on those bonds negative. We've seen it before, but it wasn't policy. It was just due to financial uncertainty and panic at certain points, but it wasn't policy by the central bank to print money to go into the open market and buy not only government bonds, but corporate bonds and corporate stock. That's what they're doing in Europe, that's what they're doing in Japan, and they've mentioned that they would do that here, which is pretty scary if you think about it, because now you have the Federal Reserve who can print money and buy corporate stock and basically gain control of corporations. So you have monetary authorities basically taking over certain portions of the capital markets, which is unprecedented. Okay, do you have one more comment? No, anybody else before I move on? I think it's really interesting but somewhat disturbing, but we're rewriting the textbooks right now. Because remember, in your capital asset pricing model and in your risk premium model to determine the cost of the debt and the equity, you now have risk-free rates, which is the yield curve. The yield curve, the majority of the yield curve is negative in some of these countries. Again, the models were not designed for negative interest rates.
Okay, so I'm just making sure, negative interest rates affect asset prices to bubble, and then that causes bond prices to be inflated, stocks go down, or per deal?
No, the stocks to be inflated also,
Okay,
along with real estate prices.
okay, thank you.
So did you get all of them? You know, first drives down the currency to stimulate, and then it affects financial institutions, it affects savers, it impacts the banks.
So if there's like this negative interest rate, and you said does it create housing price bubbles as well? You're saying?
Theoretically, if it drives down mortgage interest rates extremely low, like it did in 2004, 5, and 6 in the United States, it would create asset price bubbles in the housing market.
So couldn't that lead to another crash?
Yeah. Yeah, asset price bubbles eventually, when the monetary authorities unwind the negative interest rates and go to positive interest rate environments, then the asset prices are pricked and the markets basically correct significantly and quickly.
Yeah, I know it's short now.
It basically happened in the financial crisis. Interest rates were way too low, way too long. It created the asset price bubbles in the housing market, and then eventually that market collapsed. Okay. The other is yield curve dynamics. Extremely important to understand the effect of yield curves. And again, you need to write this down. Yield curves are risk-free rates. Okay? The yield curve is a reflection of risk-free rates for U.S. Treasury securities at differing maturities. Okay, so each yield to maturity or each interest rate for each maturity of the bond is a risk-free rate. So the yield curve is a reflection of the risk-free rate. Okay? And the risk-free rate is important. The yield curves are important because risk-free rates are in the risk premium model, which determines the cost of debt and the expected return on the debt. And the risk-free rate is in the capital asset pricing model, which determines the cost of the equity and the expected return on the equity. So it's really important to tie yield curve dynamics into the risk-free rates that determine the costs of capital for the firms and expected returns for investors. Okay? So the question becomes, do you understand the Fisher equation? So this is kind of a midterm orals also. So I'm going to start asking a bunch of questions to kind of test your logic and can you answer the questions correctly. So what is the risk-free rate? I mean, what is the risk-free rate using the Fisher equation? What is the Fisher equation? What is the Fisher equation? And what I would do is I'd be writing a lot of notes because it'll make it a lot easier to study for the in-class exam.
Constant real rate plus inflation.
It's the real rate plus
Inflation expectation.
inflation expectations. And real rates do not move in the short run. So the nominal interest rates, the risk-free rates are driven by, up and down by, nominal interest rates or the risk-free rates are driven up and down by
Inflation expectation.
inflation expectations. Okay. So if the inflation expectations go up, what happens to the yield curve? If inflations go up, what happens to the yield curve? It shifts up. And if inflation expectations go down, it shifts down. If the yield curve shifts up, what happens to risk-free rates? If the yield curve shifts up, what happens to risk-free rates? They shift up. They go up. And if the yield curve shifts down, risk-free rates go down. Okay, excellent. If the yield curve shifts down and risk-free rates go down, what direction does the cost of debt and cost of equity go? So if the yield curve shifts down and risk-free rates shift down, then the cost of the debt and the cost of the equity goes. Remember, the risk-free rate is in the risk premium model and is in the capital asset pricing model. So if the yield curve shifts down and the risk-free rates shift down, then the cost of the debt and the cost of the equity, or the expected return on the debt and the expected return on the equity goes down. And if they go down, what happens to the value of the bonds and the value of the stocks? They go up. Okay. So being able to tie the inflation expectations into the nominal interest rates, which are the risk-free rates, and the movement up and down of these risk-free rates is going to cause the expected return and the cost of debt and equity to go up and down. And if they go up, then the valuations go, question, If the risk-free rates go up, then the valuations go. If the discount rate goes up, then the valuations go down. If the discount rate or the risk-free rates go down, then the valuations go up. Okay. So you have to tie the yield curve using the Fisher equation into the inflation expectations. That's going to shift it up and back, which is going to drive right into the risk-free rate, which drives right into the risk premium model, which drives right into the capital asset pricing model, which drives those costs of capital and those expected returns up and down. And if it's up, valuations go down, and if it's down, valuations go. Okay? And you should be thinking about the perpetuity model, and the Gordon growth model, and the multiple model, and the discounted cash flow model. So the shifts in inflation expectations have a direct impact on yield curves, risk-free rates, and valuations for stocks, bonds, real estate, and other assets. Okay? So that's what I was really looking for. And then underneath, I asked you, do you know the cost of the debt calculation using the risk premium approach? So what's the first variable in the risk premium or risk premium model that determines the cost or the expected return on debt? What's the first variable? What's the first variable in the risk premium or premium model?
Is that the risk-free rate?
It's the risk-free rate. And then what do? How do you calculate, how do you build the cost of the debt or the expected return on the debt? What else do you do? You can't borrow at the risk-free rate only, the government can. So what do you have to do next?
To add the risk premiums.
What?
You have to add the
You start adding the risk premiums. So give me examples of 3 risk premiums.
Credit default.
Credit default,
Illiquidity.
illiquidity. One more. You should have these written down. Immaturity. Excellent. Nice job. What's the capital asset pricing model? What's the first variable in the capital asset pricing model? What's the first variable? Okay. What is it? What's the first variable in the capital asset pricing model? Risk-free rate. Excellent. And then what? Then what do you do? Give me the rest of the equation. So it's a risk-free rate. Then what?
Plus beta.
Plus beta. Keep going. Times the return on the market. Go ahead. Minus the risk-free rate. Excellent. Nice job. So remember, if the risk-free rate goes up, then the cost of the debt and the equity goes up. If any of the risk premiums go up, the cost of the debt goes up. If the beta goes up, the cost of the equity goes up. If the expected return on the market goes up, the cost of the equity goes up. Okay? And then you feed those right into the bond and stock and real estate and firm valuation models. Okay? Weighted average cost of capital, how do you calculate that? You already know how to calculate the cost of the debt using risk premium. You know how to calculate the cost of the equity using CAPM. Then how do you calculate the weighted average cost of capital? How do you come up with the weights? It's just a weighted average.
Interest weight of equity or debt, or times your weighted, or your weight of your equity or debt.
Okay, and then we're doing the WACC, so you have to do the debt too.
And then it's the same thing, the interest rate of the debt is the weighted debt.
Yeah, and then you probably want to do a tax shield, 1 minus the tax rate, times the cost of the debt. That would be the theoretically correct thing to do. Okay. Can I use the book value of the debt to calculate the weights? Can I use book value to calculate the value, the weights? Can I use book value of the equity and book value of the debt to
Yes.
calculate the weights? Yes. Can I use market value? Can I use the market value of the debt and the market value of the equity? Yes, I can do that too. Okay. And what's the goal by corporations when they are determining the weighted average cost of capital? What's the goal? To minimize or maximize WACC? Do you want to minimize the cost of capital or maximize the cost of capital? Minimize or maximize?
Minimize.
Minimize the WACC. Okay. You want to maximize the spread between the internal rate of return on the assets and the weighted average cost of capital. You want to maximize the spread. So you maximize internal rates of return and minimize weighted average cost of capital. Okay. So those are just some, basic exercises. And then the dynamic yield curves. If the yield curve inverts, what are inflation expectations? Using the Fisher equation, if the yield curve inverts, are inflation expectations positive, 0, or negative? Negative. When the yield curve inverts, how much time do you have until the stock market peaks? 12 months. And how much are you normally, how many months until you're in a recession? 24. That's what I'm looking for. Modern portfolio theory. Why would you add alternative assets to a stock bond portfolio? Why would you add cash value life insurance or direct private equity real estate or alternative renewable energies, private equity? Why would you add that into a stock bond portfolio?
To diversify.
What?
Drives the risk down.
It would drive the portfolio risk down
To diversify
for diversification purposes. So to get diversification, do the returns on the alternative assets, are the returns positively correlated to stock and bond returns? Or do they have low, no, or negative correlation in the returns to stock and
Low,
bonds?
no.
Low, no.
Low, they have low, no, and negative correlation. Alternative asset returns have low, no, or negative correlations with stocks and bonds. So that if you add alternative assets into a stock bond portfolio, what does it do to the efficient frontier? What does it do to the efficient frontier if you add alternative assets to your stock bond portfolio because they have low, no, or negative correlation in the returns to stocks and bonds? What does it do to the efficient frontier?
Pushes it down.
I'm looking for a specific term. I mean, that's pretty close, but I'm looking for terminology. What does it do to the efficient frontier? And a lot of you, I actually wrote this in your exams. When I sat down with you individually, I wrote you through it. I told you what it did. Because you guys did a great job of laying out the efficient frontier and showing a lot of the details in it. But this was the piece that I was really trying to get to. Obviously, you got your utility curves. When the utility curve is tangent to the capital allocation line in the efficient frontier, what is this right here? What is that dot right there? Yeah, that's the market basket. Excellent question. And if we add alternative assets to the stock bond portfolio, usually 100% stock, 100% bonds, what does it do to the efficient frontier? Exactly, it bows it out. And will it reduce the expected return on the portfolio? Will it reduce the expected return on the portfolio? Yeah. Will it reduce the portfolio risk? Will it reduce the portfolio risk more than the reduction in the expected return? So what happens to the risk-adjusted rates of return when you add alternatives into a stock bond portfolio? What happens to your risk-adjusted rates of return? They go up. They go up. So your expected return, portfolio standard deviation, yes, your expected return goes down, but your portfolio standard deviation goes down even more significantly. Therefore, your risk-adjusted rate of return goes up. Are risk-averse investors better off? Are they better off? Yes, they are. They're better. And do I really care if I reduce my portfolio return from 10% to 8%?
No.
Do I really care? No, because I'm still going to double my money in less than 10 years. So I would rather have the reduction in the risk way more than the reduction in the return, and I'm still getting an 8%, which means my money doubles in less than 10 years, so I'm still there. So that's kind of what I was really looking for, in there really zeroing in, and then giving me, if you can give me the target portfolio, the target allocation, which was 40% bonds, 30% stock, which is pretty traditional, and then 10%, 10%, 10%. 10% cash value, 10% private equity real estate, direct, and then 10% alternative renewable energy. And I'm just hearing more and more about that sector every single day, okay, and its benefits. Let's talk valuation theory. What's the perpetuity model? What's the perpetuity model?
Cash flows, T+1 over, interest rate.
Yeah, I wouldn't use the interest rate. Okay. You could use cash flow over interest rate if you're valuing government treasuries, right? So I can take a perpetuity bond, figure out the coupon, and then apply the interest rate. But if we're valuing stocks or corporate bonds, we're really applying the discount rate or the expected rate of return or the cost of the debt or the equity. Okay. Or if we're doing discounted cash flows on a piece of real estate or a company, we're probably going to use the weighted average cost of capital as the discount rate. The model structure is still the same, but it's really just nomenclature, it's nuance in what the I is. So the cash flow is not last year's cash flow or this year's cash flow, it's next year's cash flow. So it's forward-looking, okay? And then the I, again, the I could be the interest rate if you're doing government bonds. It would probably be the risk premia model if you're doing corporate bonds. It could be the capital asset pricing model. You could be using that as the discount rate. If you're valuing stocks, using earnings per share or some other expected return. I want to get a return on the stock. I'm going to use my expected return as the discount rate to do the valuation. Okay. But the model structure is basically the same. All right. What about the Gordon growth model? Can you tell me about that?
Cash flows T+1 over I minus G.
Yeah, and then we already know what I is, right? And we know what the cash flows are. So what does G tell you?
Growth rate.
It's growth rate in the, yeah, it's the expected growth rate in what? Expected growth rate in what? Is it a constant growth rate?
Yeah.
Yes, it's a constant growth rate in what? In the cash flows, exactly. So you're assuming that cash flows are going to grow at a constant rate forever. Okay, forever. All right. In the multiple model, tell me the model structure for the multiple growth.
Cash flows T+1 multiplied by the multiplier.
By the multiple. Yeah. Do we want to use last year's multiple, this year's multiple, or next year's multiple? Next year's multiple. Okay, so it's always forward-looking. And then what are the three methods that we can use or calculate the multiple? What multiples can we use and how can we derive those multiples? What are the three methods?
1 over I.
Yeah, so 1 over I. So you're using basically the perpetuity model to calculate a multiple. So 1 over I is going to give you a multiple. You can apply it to the cash flow, T+1 to get the valuation. What's another method?
1 over I minus G.
Yeah, 1 over I minus G, we can get the, and what are you assuming? What are you assuming when you do 1 over I minus G about the cash flows?
Constant.
You're at a constant rate. And is the multiple for the Gordon growth model going to be higher or lower than the perpetuity? Is the multiple going to be higher or lower for the Gordon growth?
Higher.
It's going to be higher. It's going to be higher. Okay. It's going to be higher. So remember that too when you're using perpetuity or Gordon growth to calculate the terminal values for the discounted cash flows. If you're using Gordon growth, your terminal value is going to be a lot higher, and it's going to have a major impact on your present value or your net present value. So what method you use to calculate the terminal value is going to have a major impact on your present value at the end of the day. And I'll talk a little bit about how investment bankers and corporate finance people and, real estate underwriters manipulate the underwriting process that we're doing here in the discounted cash flow by inflating the terminal value to get the projects accepted. So that's like the dirty little secret of that. So tell me about the discounted cash flow methodology. Can you walk me through, if you were asked to walk me through how you would approach a discounted cash flow model? What would be the steps? What would be the structure of the model? How would you create and calculate a discounted cash flow model? What's the first thing you would need to do? And again, what we're doing is we're building on this, and we're going to use it in the case studies. So walk me through the discounted cash flow model. What's the first thing that you would do?
Is it the percent of growth of cash flow?
Well, that's not the first thing you would arrive at. You would want to get something first before you start applying the growth rates. And I would probably write this down in your notes, step 1, 2, 3, 4, 5, 6, so you can go through all of it and then memorize the steps. So what's the first step that you would do? What's the first thing you would need in a discounted cash flow or a DCF model?
Cost of capital?
We could do that first, but let's do something else first. Let's focus on the other variable first.
Holding period?
Okay, we could do that too. Let's say we do that first. How many years do we want to hold this thing? So let's do that first. Does it really matter if you hold the asset for 3, 5, or 10 years when you're doing the analysis? No, because the terminal value will capture all those cash flows past the holding period year. Okay, so first thing is the holding period. Okay, what's the second thing we want to focus on? We can do the discount rate next. So what do we do next? So how would we determine the discount rate, or what are some definitions of the discount rate? What are some ways of determining the discount rate? One could be the weighted average cost of capital. Okay, you could use that. What's another one that you can use?
Cost equity,
Cost of equity using what model?
capital asset.
Capital asset pricing model. Nice job. Could you also come up with some kind of expected return? I want a 22% rate of return on this. Could you just come up with an expected return? Yeah, you could do that too. Okay, so now we got the discount, we got the holding period, we got the discount rate. What else do we need?
Cash flow.
We need the cash flows. Now, are we going to use last year's, this year's, or next year's cash flows? Next year. So next year's cash flow is going to be year 1. Okay. Then what do we do? Then what do we do? Then what do we do to the cash flows?
We divide it.
No. Not yet. Then what do we do to the cash flows? Out over the holding period. What do we do to the cash flows? No, you're right. What do we multiply the cash flow by? No,
Terminal.
no, go for it. What do you multiply the cash flows by? What? Yeah, by the growth rate. Okay. So you're going to grow out the cash flows at some rate over the holding period. Okay. Do you need to grow the cash flows out an extra year? Yes or no? Yes, you do. Okay. And why would you do that? Because you got to get the terminal value. And what methods can you use to apply to that, let's say, 4th year or 6th year or 11th year cash flow? What models can you apply to get the terminal value? Perpetuity?
Gordon
Or-
growth.
Or Gordon growth? Can I use the multiple approach too? Yeah, I can use that too. Okay. If I use perpetuity, am I assuming the cash flows are going to be constant forever or grow at a constant rate? If I use perpetuity, are they going to be flat forever or grow at a constant rate? They're going to be flat. Okay. If I use Gordon growth,
Right.
they're going to grow at a constant rate. Okay. And can't I also calculate a multiple using the perpetuity and the Gordon growth model and get the same results? Yeah, it gives me the same results. Okay. So now we got the terminal value. What do we do with the terminal value?
Add it to the last year cash flow?
We add it to the last year in the holding period. Excellent. And then what do we do now? What's the next step?
You divide it by
You divide the cash flows by,
1 plus I, and then 1 plus I.
to the 1, to the 2, to the 3, to the 4,
Yes,
to the
one
5.
over here.
So those are gonna be the discount factors. Okay, so then you calculate the discount factors. Then what do we do? Now we got the cash flows, now we got the discount factors, now what do we do? Now what do we calculate? So we got the cash flows, and we got the discount factors, now what do we do? Because we're trying to get to the present value.
The cost of debt.
No.
Just add them up.
Do you add them up, or do you do something first? Yeah, you divide cash flows by the discount factors to get the discounted cash flows. Okay, you wanna write this down in that order. Once you get the discounted cash flows, then what do? Somebody just said it. Yeah, you have to do something first. What do you do with the discounted cash flows? You add them up. And what does that give you?
PV.
Present value. Exactly. Excellent. Nice job. Once you get the present value, if you subtract the cost of the acquisition, the cost of the project, and you get a negative net present value, do you accept or reject it? Reject it. But what if you want it? What if you want it? Then what could you do?
Go back and look at it.
Not yet. What could you do right off the bat? You're getting a negative net present value on a project. What could you do? What?
Change the rate.
No, not yet.
Acquisition cost,
What would you do?
acquisition, like,
What would you do? Would you reduce it or increase it?
reduce
You would reduce it in what amount?
The amount that it's over. You reduce it to get 0, right?
Yeah, so if you're getting a negative net present value,
You reduce it that negative amount.
you got it. You would reduce the cost or the acquisition price in the amount of the negative net present value. Once you do that, the net present value is equal to what?
0.
0. Would you accept or reject the project? Accept it. Okay. Then, go ahead. Now, if you're still getting a negative net present value,
You can change the rate, or you can go back and look at it and see where you went wrong.
then you go back and audit your assumptions. If you still get a negative net present value, then what do?
real call.
You calculate the real call option. And if the value of the real call option is equal to or greater than the negative net present value, then what's the net present value? If the real call option value is equal to or greater than the negative net present value, then what is your net present value?
So,
Equal to?
Zero.
It's either equal to 0 or positive. And then would you accept or reject the project? Accept. Okay. So we'll go through that again, but that's kind of the iterative process. Okay. You guys are doing really, really good. Okay, so let's do the case studies. Yeah, I'll probably write out. So there's 3 case studies. There's an investment banking, which we went over in class, where we're basically buying another company. There's another one where we're doing a development in Mission Bay, and the other one we're doing a stock valuation. Okay. So the first one is the investment banking. We're taking over a tech company. So last year's cash flow was $200 million. I already got the growth rates right here, so we know what the growth rates are all the way out through the 6th year, and this is a 5-year holding period. By going in, I could actually even do, can I do a valuation on this firm using perpetuity and Gordon growth? Yeah, so I just have to grow out the 200 million by 20% to get next year's cash flows. And can't I divide it by the 22% weighted average cost of capital to get the valuation? Can't I also divide it by the 22% minus the 5% going in growth rate and use the Gordon growth model to do it? Could I also take 1 divided by the 22% to get a multiple and multiply it by next year's cash flow to get a valuation, which will be the same as the perpetuity? Could I do 1 minus the WACC minus the 5% to get the Gordon growth valuation, or 1 divided by I minus G to get the multiple times next year's cash flow to get the same value. So there's different ways of getting at it. But what we really want to focus on is the discounted cash flow. We do have a capital structure here, but I've already calculated the WACC for you. Both the going in WACC that you're going to use to calculate the discount factors, and the terminal WACC that you're going to use to apply Gordon growth for the terminal value. I also gave you a terminal discount rate too. I mean a terminal growth rate to apply to the Gordon growth model to calculate the terminal value. So I get a lot of the variables are already in here for you. The cost of the acquisition is $4 billion. So what you're going to do is you're going to calculate the valuations. And then you're going to calculate the present value, net present value, internal rate of return, and break even. You don't have to do the IRR. If it's negative, if the NPV is negative, is your IRR greater than or less than your WACC? It's less than. Okay, it's less than. If the net present value is positive, is your internal rate of return greater than or less than the WACC? It's greater than. Okay. So I just want to see if you just know that logic. And if the net present value is 0, what is your internal rate of return? It is the weighted average cost of capital. When the NPV is 0. Okay. So you need to kind of just, I'm not really need you to know how to calculate the IRR, but know how to interpolate it. Okay? And then you're going to get the NPV. And we know that the NPV, if it's negative, you're going to reject it, but if you want it, you ask for a price reduction in the amount of the negative NPV. If you can't get the price reduction, you go back, you re-look at all the assumptions. Let's go through the assumptions really quickly. What assumptions would we audit if we had to go back and review our discounted cash flow methodology? What variables would we look at?
Growth rate.
We look at the growth rates and the cash flows. Okay, what else would we go back and look at?
Your factors that went into calculating your discount rate?
Yeah, so we probably look at the capital structure, see if that's right. Go back to the risk premium model, see if we calculated the cost of debt right. You go back to the CAPM model, see if we calculated the cost of the equity correctly too. And then since there's risk-free rates in there, we probably go back and look at the forward-looking risk-free rate curve, see how our projections were in forecasting forward risk-free rates. What other variables would we look at? We have growth rate, we have discount rate. What other variables? There's a couple more. So we got the growth rate and the cash flows, we got the discount factors taken care of. Do we gotta go back, do we have to go back and audit the calculation of the terminal value? Yeah, could we have overestimated the terminal discount rate? Because if it's too high, the terminal value is low and it will push down the present value and the NPV. So we gotta look at that terminal discount rate. What about the growth rate assumptions? Could we have over or underestimated the growth rate for the constant growth rate in the cash flows? Would we have over or underestimated the G? We would have underestimated the G. So we gotta go back and see if we underestimated the G. Because if the G was underestimated, then the terminal value is low, the present value is low, and the NPV is lower. Okay. So if we increase G, that pulls up the PV and MPV. If we lower the terminal discount rate, that pulls up the PV and MPV. If we lower the discount rate, or our expected rate of return and reduce that, that's going to pull up PV and MPV. And if we increase the cash flow growth rates over the holding period upwards, that's going to increase PV and the MPV. Okay. So the secret to some of these underwritings is they will be relatively conservative in their cash flow projections over the 10-year pro forma period. Because the 10-year is the standard. And what they'll then do is they will increase the growth rates and reduce the terminal discount rates on the back end to inflate the terminal value to get the PV and the MPV to be higher to get the project accepted.
What if the original growth rates were like the right ones when they kind of accepted the projects? Like,
What if you made a mistake and changed it
yeah.
and made it net negative?
Well, I'm saying, like, what if you yeah, what if it ended up being like you should have rejected it, but you did all these changes of like what kind of wishful thinking?
Well, that's my point, that's where I'm getting at, is that what incentivizes investment bankers and mergers and acquisitions experts in corporate finance departments? What are they motivated by? What's their motivation? Are you working in the corporate finance department, are you working in investment banking at Goldman? What is your incentive? What is your motivation?
Increase your rate of return.
Well, you personally, right? What's your personal motivation? You as the individual, to make money, okay? Now, do you make money rejecting projects or accepting projects? Accepting projects. Do you get bonuses when you reject projects, or do you get bonuses when you accept projects? When you accept them, okay? So the motivation, and then you get into the ethics part about it. The motivation is to actually look to make some of these projects look better than they actually are, because you're incentivized, you are paid to produce projects that then get accepted. The problem is that if they get accepted, they should have been rejected, it could cost the company millions and millions of dollars. But that's not the incentive. The incentive is through compensation and bonuses to actually make the projects look better than they otherwise are, and the way you do it is you inflate the terminal value, because it's on the back end, and nobody looks at the terminal value calculations. They look at the pro forma, they look at the growth rates and the cash flows and the income statement, they analyze that, they don't look at the terminal value calculations and how aggressive you were on your growth rate assumptions using Gordon Growth. So that's the dirty little secret of how I've seen underwriters push through projects that should have been rejected to get accepted by the investment committee and the board, only to find out later that the projects failed because they made them look better than they did. And I guess if you make more look better more often, then it will cover up the mistakes from your underwriting in pushing through projects. You can only do it for a certain amount of time until the projects start to fail, and then you go back to the underwriters and say, hey, where did you make your mistakes? And then if it's consistent, persistent, and if there is unethical behavior, then they will get fired. Okay, because it's too costly to the firm. You're losing millions or millions in the process. Did somebody have a question real quick? No, okay. So the investment, the real estate investment banking is basically a modification of the Mission Bay project. The net operating income projected for the base period is $125 million. We've got the going in G for Gordon Growth at 2%, the terminal G is 1%. We have a gross potential rental income of $150 million. The expected return on this project going in is 12%. The terminal, the back end for the terminal value is 14, so I already adjusted it 200 basis points to reflect the additional risk in 6 years from now and beyond. We have the growth rates, so we multiply the 125 million times 1.1 to get the first year in the holding period cash flows, and then grow them out through to the 6th year. Once you get to the 6th year, you already know the terminal discount rate, and you also know the terminal G, so 13%. You know the cost of construction, which is $1.25 billion, and it's a 5-year holding period. So I want to see that you can walk through and do the mathematics. If the net present value is negative, would you accept or reject the project? You'd reject it, but what if you want it? What if you want it, what would you have to do? What's the second iteration? I get a negative net present value, I should reject it, but I really want it. What's the second iteration?
Go back and
Reevaluate.
No, that's the third.
Acquisition cost?
Yeah, you would reduce the acquisition cost in what amount? By what amount?
To make it 0.
Yeah, so you would reduce the see if you could reduce the acquisition cost in the amount of the negative net present value to get it to 0. But if you can't reduce the acquisition, the construction costs What's the third iteration?
Go back
You go back and look at the assumptions. Go back and look at the discount rate, growth rate, the cash flows, the terminal discount rate, the terminal growth rate, using Gordon growth. You go back and you look at the expected return, see if that's reasonable, maybe you overestimated it, the return. And then you go back. But if you go back and you audit all the assumptions and you still they're correct, and you still have a negative net present value, then what do? What's the iteration for?
real call option.
You calculate the value of the real call option. And what does the value of the real call option have to be?
Zero or positive.
It has to be the amount of what?
The negative.
The negative net present value. So if the real call option is equal to or greater than the negative net present value, then what's your net present value?
Zero.
0 or
Positive.
something positive, and then would you accept it or reject it?
Accept.
You'd accept it. And if the real call option is less than the negative net present value,
Reject.
you would reject it, because the net present value is negative. Okay. And that's where it ends. You can't go any further than that. Okay. Any questions on that? Okay, the next one is the stock valuation. I'm testing you here to see if you can value the stock using the 4 methodologies. So you already have the earnings per share last year. You know what the growth rate is for next year, which is 5%, so 13 times 1.05, now you got it. Okay. Now you get the forward earnings per share. Now you can divide it by the going in expected return of 8% to get perpetuity. 8% minus the going in growth rate, which is 7%, divided by next year's EPS, you get the Gordon growth. Okay. Then the multiple approach, could I calculate the multiples using perpetuity or Gordon growth?
No.
Could I do 1 divided by the expected return, or 1 divided by the expected return minus the growth rate? Yeah, I can do that too. I also gave you a multiple too, of 15. So can I use next year's earnings per share multiplied by the PE multiple to get a valuation? Yeah, I can do that too. Okay. Now it's the discounted cash flow. So we got the earnings per share last year, we grow it out, we get the first year, all through year 5, 1 more year to get year 6. Now what do we do with the earnings per share for year 6? What are we going to do with that? I grew out the earnings per share from year 5, which is the last year in the holding period, to year 6. What do I do with the 6-year earnings per share?
Find terminal value.
I try to get the terminal value. So I already gave you what the terminal expected rate of return and the terminal growth rate is to be able to calculate the Gordon growth, which is 0.09. So you take the 6 years EPS divided by 0.09, you get terminal value for the stock, and then what do you do with that? What do you do with the terminal value for the stock?
Yeah, add it to your last holding period.
Add it to the last year in the holding period, and then discount it back using the expected return of 8% after calculating the discount factors.
You said you subtracted the 10 minus the 1 on the growth?
So for the Gordon growth, based on next year's cash flows, it's going to be the expected return minus the 1%. So the going in expected return minus the going in growth rate. Okay. But for the terminal value, you can use the 6 years earnings per share. You can use the terminal discount rate or expected return minus the terminal growth rate to get the terminal value to add to the 5th year in the holding period, and then discount that back to get the present value of the stock using the discounted cash flow model. So now you have the perpetuity, Gordon growth, PE multiple, and the DCF model. I'm going to ask you now, how do you want to weight those to get the intrinsic value?
You put the most on the DC.
Most on the DCF, the second on multiple, and then less on the Gordon growth and the perpetuity. So I want to see what your weights would be. Okay. So once you calculate the intrinsic value, the weighted average intrinsic value, if it's higher than the current stock price of $157, what is your recommendation? What would be your stock recommendation the intrinsic value is higher than the current stock price, what would be your recommendation? If the intrinsic value, you buy,
Buy
what
a
others-
margin,
buy a
calls,
margin,
and
buy calls, right puts. So there's 4 right there, okay? And what if the stock that we're analyzing makes up a significant portion of a technology exchange traded fund? And the prices of the stock and the prices of the ETF are highly correlated. What would be the trades on that? What would be the trades on the technology ETF? What would be the trades on that? Again, remember the stock is a major component of a technology exchange traded fund. So the returns and the price of the exchange traded fund and the stock are highly correlated to each other. So what would be the trade recommendations for the ETF? Buy it, buy a margin, write puts,
buy calls.
buy calls. So how many trades do I have now?
Cool.
8.
I have 8, okay. And what if this company stock makes up a significant portion of a technology stock price index, and the returns in the index, on the stock and the index are highly correlated? What would be the other trades that you could potentially do to make money or recommend your clients on the indexes? What kind of trades on the index could we recommend? For forecasting the value of the stock to go up, which means that we're forecasting the exchange traded fund shares values to go up and the index values to go up, what would be the derivative trades on the indexes, on the index?
Buy forwards,
You buy forwards,
buy
buy
futures,
futures,
buy call on futures.
buy calls on futures,
Right.
and write puts on futures. So now how many trades do we have? 12. And then the last portion, how much time do I have? And the last is really the matrix, the investment decision-making matrix that we've already gone over a bunch of times. I want to see the matrix with the 4 iterations. Okay. Present value greater than price, present value equal to price, present value less than price. Net present value positive, net present value equal to 0, net present value negative. Internal rate of return greater than WACC, equal to WACC, less than WACC. Break even, less than 3 years, equal to 3 years, greater than 3 years. So it's going to be accept, accept, reject, accept, accept, reject, accept, accept, reject. If the net present value is negative, the second iteration would be to do what? And you can just write it in the column. What would you do in the second iteration if you had a negative net present value?
Reject.
If you had a negative net present value, the first iteration would be to reject it. The second iteration would be if you still wanted the project and you had a negative net present value, what could you do?
Just cost of buy.
You would reduce the cost or reduce the acquisition price. In what amount?
The amount
Equal
that's
to
needed.
The amount of the negative net present value. So just write that in the column. And then the third iteration, if you can't get the price or the cost reduction, you would then do what?
Go back and
Would be your third iteration.
review the.
Go back and review your assumptions. And then if you still get a negative net present value, then what would you do? The fourth iteration would be to do what? Calculate the real call option. And what does the value of the real call option have to be?
Equal to net present value.
It's got to be equal to or greater than the negative net present value to get the project to be accepted. Okay, that's it. So that's what I'm looking for. So just, reinforcement becomes totally natural. Okay, just becomes totally natural. Okay. You can do that. If you have any problems, if you want to call me or text me, or don't email me, but call me or text me. I'll walk you through if you're having any problems. Okay. Right, so that was kind of an oral review of the exam. I didn't get a chance to get through the PowerPoints. I think a lot of it is review, but I think some of the major takeaways is I'll do it in the last 5 minutes, is not only the capital budgeting side of it and the cost of capital, which I think we already went over, but the key is really the chapter on capital structure, optimal capital structure. What you need to understand is that there is an optimal amount of leverage, optimal amount of debt that a firm can take on that will maximize the value of the firm. Okay. So you can use debt to equity, or you can use debt to total market cap. So those are basically your leverage ratios. And this is the value of the firm. And you basically take on, the value of the firm increases the more debt you take on up to a point. And then the more debt you take on, it actually starts to destroy value, because you're taking on too much financial risk. So there's a optimal debt to equity or an optimal debt to total market cap that's going to minimize the weighted average cost of capital. The problem is if you start taking on more leverage, and the incentive to take on more leverage is to juice up the return on equity, using borrowed funds to increase your return on equity. So firms have incentives to take on more debt. And one of the reasons why they have an incentive to take on more debt is because the interest on the debt, the interest on the bonds are tax deductible. So that tax shield, the accounting tax shield, incentivizes firms to take on more debt. And if they take on more debt, what happens is once you exceed the debt to total market cap or debt to equity, the optimal leverage ratio, your cost of equity and debt moves up exponentially, because the investors start to realize that you're over-levering the firm. You're taking on too much debt. And if you go into a downturn and your sales and your earnings and your revenues start to drop because you're going into a recession, the significant portion of the earnings got to go to service the interest on the debt. And if there's not enough money to service the interest on the debt, the bonds will go into default. The bondholders will sue the company and force them into bankruptcy to liquidate the assets to pay off the bondholders. So at some point, once you exceed this optimal debt ratio level, the equity investors and the bond investors will see that you're taking on too much financial risk and start to increase their expected rates of return to be compensated for the risk, and that will cause their stock price and their bond prices to go down and exacerbate the situation. Okay. So that was really the major takeaway from that chapter. I think we went over the capital budgeting stuff enough. And then I'll talk, maybe on Thursday, I'll talk more about new venture capital finance, just hit on some highlights, and then we'll spend like an hour. Bring your problems. If you have any problems on your homework or on your exam, I'll bring the solutions. We'll break up the teams. We'll do like we did before, have a little fun, and then solve a bunch of problems and then get ready for next week. Okay? All right. Thank you. You guys can break.